So, seasoned investors are also human beings. They also fall prey to emotions. None of the people managing funds are machines in that sense. 5 years, 10 years back, a wide distribution network, good brand, was seen as a big moat, was seen as a competitive advantage. With e commerce coming in, you can outsource logistics, you can outsource manufacturing, and these direct to consumer companies are gaining a lot of market share. Investors can invest in all kinds of businesses. Let me give three broad categories. One would be a
The way you invest often says a lot about who you are. It's rare to find a true value investor who's flashy or extravagant. Such investors won't buy expensive things if there's an affordable alternative available. In today's episode, we are joined by one of the most respected names in the industry, Mr. Rajeev Thakkar, Executive Director and CIO of PPFAS Mutual Fund. Thank you so much, Mr. Thakkar, for joining us in our podcast series.
thank you, pleasure being here, Abneet.
What do you believe about the world that most investors don't? Do you believe the world is getting better or more dangerous?
I think both are simultaneously true. So while day to day the world is significantly better than what it ever was. A lot of people have mentioned this. Something like air travel, even the richest person 200 years ago would not be able to do because that did not exist. Air conditioning was not available to the richest people maybe 150 years ago. So a lot of things have been invented. Lifespans are increasing. Access to electricity, access to automated vehicles, access to machinery, the entertainment options that we have today, all these did not exist earlier. So, in that sense, the world is becoming better. The huge section of people across the globe have come out of poverty and the minimum standards of living have increased. The area for concern is that with the advancement of technology and with the distances shrinking, the potential for harm also has increased. So, with a lot of people or a lot of countries having access to things like nuclear weapons, the threat of cyber warfare or bioterrorism, so these kind of things could break out someday and could cause huge amount of harm. Day to day, things are lot better, but at the same time, one has to be continuously vigilant.
From investment angle, what about for investors? How should they feel about this?
I don't think investors can do much about this. So Stephen Covey beautifully points us out in the Seven Habits of Highly Effective People. There's a big circle which is called circle of concern. In that, there are all the things that you can worry about and that will affect your day-to-day life. But most of the things are things that you can do nothing about. So, can you and I, as investors, control what will happen to geopolitics or to conflicts between two nations? Answer is unlikely. We can't do much at an individual level. However, worrying too much about this does not make sense. So, meteor strikes Earth and wipes out life, then that's something which is completely beyond our control. But day to day, we have to live with optimism. We have to live to meet our financial goals, invest accordingly, keep the risks in mind, have an asset allocation which is appropriate to our needs. So day to day, things don't change much.
So, what kind of optimism long term investors should have while investing?
Investors should be optimists at the same time, should be aware of what are the pitfalls. So rather than being overly optimistic all the time or be pessimistic all the time, I would encourage people to be realistic, to try and see things as they are, look at the positive sides of things, and at the same time be aware of what are the things that could go wrong. That will allow them to not hesitate when opportunities come their way. At the same time, they would not be blind and buy anything and everything, even if the quality and valuations are not appropriate for wealth creation.
All right. So, it says a lot about your view on world at large. I guess that's how you would relate to time as well. So, do you feel you look at time differently compared to most investors? Has being early ever felt the same as being wrong?
So we urge our investors to give us a minimum time of 5 years. We ourselves also give our investee companies a long enough time in which to deliver performance. So we are not living quarter to quarter. These days, people have very limited attention time spans, and people are very impatient. So to that extent, there's a divergence between most of the world as we see it and our approach. Uh, so to that extent, being a little early uh, does not matter so much. But at the same time, we cannot have endless patience. Neither do our investors have endless patience. So if over a 5 year period, if things are not working out, obviously there will be a lot of questions asked. The good thing is that at a portfolio level, we have a collection of businesses. Now, even statistically, one would expect out of a 20-25 stock portfolio, three or four companies not to do well, but the others would more than make up for it. So, yes, we do review things that are not working out, but as long as things are doing well at the portfolio level, it's broadly okay.
So, you said minimum 5 years, but nowadays we read a lot about that minimum 7 years. It has shifted from 5 to 7. What do you think about that?
So longer the better in equities, that has always held true. However, if you look at the data put out by AMFI, by SEBI in terms of the behavior of average mutual fund investors, the average holding period is much shorter than even 5 years. So I don't think practically investors have that long horizon. Of course, averages mislead to the extent there would be some people who would have holding period of decades and some people who would have holding period of days, and the average is finally adding both and dividing that number. But average period, based on the statistics that have been put out, is somewhere between 2 to 3 years. So practically, investors are not really holding for the 7 year period that you mentioned.
Yeah, that's the most worrying part, I would say. All right. So, even now, this is where it gets tricky. So, even long term investors, they need to decide when to be patient and when to move on. So, how do you personally tell the difference between something that just needs more time and something that's actually a lost cause or dead weight?
So first thing to realize is that you cannot depend on the stock price movement to arrive at this judgment. Stock price sometimes can be flat, downward, upward. Sometimes the business may not be doing well, still the stock price would be going up. Sometimes the reverse happens. Business is doing fine, but for some reason, investors are pessimistic and the stock price comes off. So our judgment is largely driven based on business performance. Typically, we would have some idea when we go in and invest in a business as to what is the trajectory we expect the business to have over 2, 3, 5 years. Now, if quarter after quarter, year after year, if the business is not performing as per our expectation, and if the environment is also full of headwinds, then obviously we would have made a mistake. Sometimes environment would be good, but the company has very poor execution. Even then, it would be a mistake. So we would look at the business performance dispassionately and then decide what we want to do with such a position.
Any one ready made formula for investors to decide when to move on?
Investors can invest in all kinds of businesses. Let me give three broad categories. One would be a very high growth business where you would slightly pay up in terms of valuations, and that growth is also value accretive. Given that condition, you would typically be buying such a company at higher multiples. The second would be somewhere in between company with reasonable amount of growth, and the third category would be very mature businesses where you would value them on the existing cash flows. Now, if you have bought a company expecting a growth rate of somewhere around 30 or 35%, If that company starts delivering, let's say, 10% or 12% growth, then obviously there's a mistake. If a company you have bought for steady business and maybe around 5 to 6% growth, which is more or less in line with the overall environment, then if that company suddenly starts degrowing in a massive way, then obviously there's a mistake. So it would really depend on the context of your purchase decision. What were you expecting when you bought the stock, and how has the business performed maybe 1 or 2 years after you
down the line.
purchased?
So while we are on the tough decisions, let's talk about risk. What's your personal definition of risk? Do you think it's volatility, or do you think it's, is it regret? Is that the risk?
So, volatility would be risk for traders. Now, if people are buying a stock on leverage, either in futures options or doing margin trading, then obviously for such people, volatility is a risk, because if you buy something and if you have a let's say a 20% stop loss, either you yourself put a 20% stop loss or your broker will run out of margin and force you to sell. So for such people, volatility is obviously risk. For people who are paying the full price upfront and taking delivery of the stock in the demat account, then volatility is not risk. For them, the risk is if in that person's holding period, holding horizon, if the stock does not meet the minimum return expectation, or if the stock significantly comes down in price even after holding the stock for a long period of time, then that is the risk, which is you invested for 5 years or 7 years, your purchase price was 100, and after that 7 year period, it remains 100, or if it's 75, then obviously you have either a real loss or a opportunity cost. That is the risk that investors take as compared to traders.
For mutual fund investors, what kind of portfolio to prepare to avoid risk, or to get some relief from risk?
Typically, if a mutual fund investor is buying a diversified fund, that itself gives adequate diversification. So typically, mutual fund portfolios would have 25 stocks, 30 stocks in the portfolio, in some cases significantly larger. They are not exposed to just one sector or just one business. The challenge comes when mutual fund investors get attracted by past returns in a narrow set of market. So they would buy a sector which has done well over the past 12 months, or a theme which has done well, or they narrowly concentrate in a particular market cap segment of the market. So then the risk really increases. My recommendation to most mutual fund investors would be to stick to diversified equity funds. They could either go for large cap funds, or they could go for flexi cap, multi cap funds, which are diversified funds. If they go for sector A, sector B, theme C, or if bulk of their money is only in small cap funds, then the risk significantly increases in the portfolio.
So basically, chasing the past returns is what the risk is from a mutual fund investor's perspective. What about the behavioral risk?
So behavioral risk is where investors harm themselves. Many times investors know that this is harmful. So let us say eating junk food would be harmful to health in the longer term, but at the moment it feels so appealing that people give into temptation and indulge. Same way, borrowing money to invest in stocks, or day trading, or trying to time the market in terms of quick entry exit, these are very, very tempting in terms of, at least it seems that there is potential to get rich very, very quickly. Most of the times it does not work out, and typically people end up regretting such things in the longer term. Now, it's a whole subject in terms of what are the behavioral biases that investors collectively suffer, and how they uh, end up doing harm to themselves. So some of the common ones are, let us say, recency bias. People will look at last 6 months, 12 months, and extrapolate that far in the future. Something which happened 2 or 3 years ago is quickly forgotten, and something which is in the headlines today would be remembered. Then people fall prey to the anchoring bias. So a stock which was at 200 rupees at, let's say, 200 times earnings. If that stock falls to 100 rupees, even that would be 100 times earnings. But people will get anchored to the 200 rupees price and would end up thinking that 100 rupee may be an attractive price to enter, not really looking at the fundamentals disproportionately. So that is another bias people fall prey to. There are things like sunk cost fallacy or loss aversion. You have bought something at 100, it's fallen to 75. You know you have made a mistake,
Yeah.
but selling at 75 becomes difficult because you don't want to recognize a 25 rupee loss.
Yes.
You keep hoping for the stock to bounce back to 100 for you to exit. Whereas if you look at it dispassionately, maybe the direction is towards 50 or even 25. So, a lot of them, it's difficult to enumerate all of them in a short conversation. It's an interesting subject for people who want to improve themselves.
Over the years, what have markets taught you as about human nature? Do you believe that investors can take good decisions for themselves? Can they like bet on right investments? Can they invest in their best interest?
So, most of the times, people act in their own self interest. People know what is beneficial to them, people know what is harmful to them in their day to day lives. Yet, like you asked in the previous question, what are the behavioral errors, behavioral biases that people fall prey to? So, there are some of these things which are systematic, uh, where if your neighbor has become rich or claims to have gotten rich doing something foolish, the temptation to imitate that behavior is very, very strong. So sometimes people end up doing wrong things in terms of trying to imitate other people. The other problem largely is on account of either lack of knowledge and ability or the lack of time. Now, most investors will have their business or profession or their job to adhere to in the day to day activities. So, someone could be a doctor, a lawyer, a retail businessman, a wholesaler. They would be busy with their own activities. That does not leave them enough time to look at the annual reports of hundreds of companies, to look at the quarterly results, to attend the conference calls, to track stock prices on a day to day basis. So, if those people try to build a stock portfolio on themselves, they may end up making suboptimal decisions. So, for such people, I would encourage them to seek professional help in terms of investing via things like mutual funds. But otherwise, most of the time, people do act in their self interest.
Any one behavioral trait that separates successful investor from the rest?
I think increasingly these days it's the ability to delay gratification. Today, price information, fundamental information is available to each and every person within a matter of seconds. There is 24 by 7 financial TV that is there, internet, social media is there. The companies disclose results to the exchanges, which is available to all investors at exactly the same moment. So there's no information edge that one player has over the others. The edge that is there is the ability to think longer term. When everyone is thinking 1 month, 2 month, 3 months, if you can think 3 years, 4 years, 5 years, then you have an extra edge over the others.
So thinking long term is the mantra. But any mistake that even seasoned long term investors make?
Seasoned investors are also human beings. They also fall prey to emotions. None of the people managing funds are machines in that sense. What seasoned investors try and do is they try to have people in their team who are able to look at their blind spots and point out errors or have systematic rules about not overexposing themselves to a particular sector or to a particular company, and have writing rationale for purchase so that you don't fool yourself when you are revisiting the position. But otherwise, the all the biases that I referred to, which individual investors fall prey to, seasoned investors should also be mindful of those errors. So we have seen, for example, company promoters uh, fall prey to loss aversion. Business that is loss making, they will think that infusing more capital into that business will turn around that business. Similarly, investors, if they have bought a stock and they have high conviction, even if the business is not going their way, there is this temptation to average downwards and keep putting good money after bad. So, seasoned investors also need to be cautious about behavioral biases.
All right. Coming to one of the most interesting questions. So, if you had to invest for your grandchild, what would that portfolio look like? So, basically, what kind of world are you investing for?
So, I'll give a very anticlimactic answer. I would probably put in a diversified mutual fund or in an index fund, which obviously has maybe minimum of 50 stocks kind of thing. The reason for this is, and reason not to name sectors or stocks, is that what looks invincible today, with developments in the fast paced world, may not look that relevant 5 years out. So, today, personally, I have had a 22-year experience managing money for investors professionally. I have some stocks in the portfolio today which I have held on for 22 years. But at the same time, there are a lot of stocks where we needed to sell it within 2 or 3 years after purchase, because the world is fast changing, because the world changes, valuations change, business models change. 5 years, 10 years back, a wide distribution network and a good brand was seen as a big moat, was seen as a competitive advantage. With e-commerce coming in, you can outsource logistics, you can outsource manufacturing, and these direct to consumer companies are gaining a lot of market share on established FMCG players. So I would, for my grandkids, probably buy a diversified fund rather than buy some select stocks.
So, you spoke about you are still holding some companies for last 22 years. So, what kind of companies are those that you have been holding for decades?
Rather than get into names, I'll give you the characteristics of the companies.
Yes.
One is those businesses have still not been disrupted. So the nature of the business today is more or less the same as it was 20, 22 years back. That is one criteria. Second, the business performance has been more or less regular growth, sometimes a little bit faster, sometimes a little bit slower. But broadly, the business managers have been executing the business properly. That is the second thing. And third, during this journey, they never became very significantly overvalued. So they were always in the moderate valuation range, sometimes slightly expensive, sometimes slightly cheap, but they were never at a level where one would be forced to completely exit it purely on the basis of valuation factors. So that has enabled me to hold on to these two or three companies over a very long period of time. Sometimes, even when the business is doing fine, management is executing properly, nature of the business does not change, but the valuation goes to such an extreme high level that then one is forced to exit.
Okay, moving on to something related to PPFAS. So, what do you want PPFAS to stand for after long after you are gone?
Staying true to the client. So, internally, every new joinee or at the time of even interviewing people, we say that as long as the client is doing fine, all of us will be taken care of. If the client, and we run open end products, we don't run decade long insurance policies or pension products and things like that. Our clients can withdraw money at a 1 day notice or a 2 day notice. So we have to be doing right by the client each and every moment. And if the client's trust is retained, if the clients are achieving their financial goals over the long run, all of us have a reason to exist, and we'll just do fine.
For that kind of legacy, you also need to stay ahead of where the world is moving. So let's talk about spotting long term trends. So, how do you stay ahead of evolving trends like shift from CDs and iPods to streaming, from satellite TV to platforms like Netflix and other OTT platforms? How do you spot these long term trends?
So I'll break up the long-term trends into two segments. One is the consumer trends, which are very, very easy to spot. So one just has to be around younger people. So older people get set in their ways. If uh, an older person has been listening to gramophone records, that person would continue to listen to those vinyl turntable records. If younger people are streaming music, then that's the trend. So consumer behavior: go to malls, go to shops, go to restaurants, look at what people are doing, read newspapers, magazines. That is relatively easy to spot. Even government induced trends are easier to spot, where things like government is encouraging domestic manufacturing, or government is encouraging the energy transition towards the renewable spaces. So those are again easier to spot. Business to business trends are slightly more difficult, where one business is manufacturing or products or services which go into some other business as inputs. So here one has to get into networking, talk to sector experts and things like that. But other trends are relatively easy to spot.
Okay, and what about AI? Where do you see the world moving with AI?
Very, very fast changing. So I don't have definitive answers what will be there 5 years from now, 10 years from now. As of this date, it has the potential to do a lot of intellectual work that would take long hours for people to do humanly. A human plus the generative AI model, in combination, they can have a very, very productive outcome. It's almost like the industrial revolution for intellectual work. So earlier machines uh, enabled us to reduce manual labor and do things at scale. So with AI, intellectual work can be done at scale and with a lot of efficiency. So right now it's existing people learning about these tools and using it in day-to-day activities. What will it do for employment longer term? What are the newer jobs that will be created? What will be the disruption? I don't have definitive answers right now. One has to keep watching.
Does it impact investing decisions in any way?
It impacts the research process at the first instance. So, uh, like I said, what would take days for a human to do manually can be done in a matter of hours. The analysts covering the sector or a set of companies can use these tools to speed up the day to day activities. Is it completely end to end automating investing? I don't think we are there yet.
Moving on to macro questions. So, what is your view on India's journey to become a developed nation?
I think a lot of things are aligning. One is that the big factors that were draining us in terms of our external trade deficit or the current account deficit, a lot of them are getting addressed. So things like energy imports are being addressed with the renewable energy or the shift towards EVs in terms of transportation. The increasing opportunities domestically is probably going to reduce our remittances for foreign education. A lot of these things are getting addressed. The impetus on domestic manufacturing will impact the import bill on things like electronics. So a lot of these things are getting addressed. The demography is on our side, where all the developed countries largely are aging and are having very, very low birth rates. We will have a younger working age population at least for next 20, 30 years. So those things are aligning. Some of the challenges we need to take care of is make sure that this demographic dividend is kept intact and does not become a disaster. We have to continuously work at providing good job opportunities, especially given that things like AI could be potential headwinds in particular sectors, and the continuous focus on economic growth, removing the bottlenecks. But I think things are looking good for the next 2 or 3 decades.
So, with lot of development happening at the macro level, we can say the area is suitable, favorable for long-term investors. All right, great. Thank you so much, sir. It was great to have you here, and thank you so much for your wonderful insights.
Wonderful interacting.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.